Hello, and welcome back to Underdog Investing. Today I'd like to talk about Lemonade Insurance. So I know the earnings call is actually coming out very soon on the 2nd of March. That's why I wanted to make a video just to reiterate the key business structure of Lemonade and why it's likely to succeed in the insurance industry. And then I'd like to talk about the stock price and what I'm planning to do. Before I jump into this, I'd be grateful if you can smash that like button and subscribe to the channel for future updates. So going straight into this is a very good article from the Motley Fool. I'm just going to go through the key points from this article. So starting with data. So the platform is designed to collect massive amounts of data, which the company uses to more accurately assess the risk associated with each customer. In theory, this data advantage should help it more effectively underwrite policies and identify fraud. So if you compare Lemonade with old insurance companies, you can see that it collects way more data. And like Kathy Wood said, the company with the most data as well as the highest quality data is likely to win in the long term. So these old insurance companies, when they write a policy for a customer, they take on average about 20 to 30 data points. That's not much. If you compare that to Lemonade, who collects on average 1,700 data points. So that's almost 100 times more data. And if you've got that much more data, then you're going to have a lot less risk when it comes to writing policies. And insurance is all about balancing risk and lowering risk. So that already puts Lemonade at a massive advantage. So moving on to a concept called reinsurance. Lemonade uses a fixed fee business model based on reinsurance. This allows the company to keep a portion of the premiums it collects whilst offloading most of the responsibility for covering claims to its reinsurance partners. Compared to traditional insurance companies, Lemonade's model should make its business less volatile by creating recurring revenue and highly stable gross margins. So the other thing about reinsurance is it actually puts them at a much better advantage as well, because if you imagine, because Lemonade has a reinsurance company who is willing to take on some of their burden, they don't have to keep as much cash reserves on the side waiting for a rainy day anymore. So now they can actually take that cash and use it and inject it into marketing and research and development and growing the customer base. Because that's the most important thing for a company like Lemonade that's small and high growth. If you compare it with Amazon, for the first 20 years, they didn't actually make any profits. What they did is every time they made any revenue, they kept injecting it back into the company to grow the customer base and basically monopolize the business. And that's what Lemonade are trying to do now, I think. So that puts them at another advantage. And if we have a look at the charity Giveback side of things, a lot of people are concerned about the charity side of Lemonade because they're worried that how can a company make money when they're giving all of it to charity? But actually, when we have a look at this, we can see that Lemonade's charity Giveback structure is made in a way that they can only give money to charity when they are able to themselves. So this is the sensible way to do it. If we have a look. So Lemonade donates a portion to charity. When individuals purchase insurance, they also make a selection from a pre-approved list of charitable causes. All individuals that select the same cause are grouped into a cohort, and if the loss ratio for a particular cohort is less than 40%, Lemonade donates a portion of excess premiums to the selected charity, up to 40%. So what that basically means is if we take a cohort of people who chose a particular charity, and let's imagine their average loss ratio was, say, 32%. So now, because their loss ratio was so low, Lemonade are now able to give about 8% of the premiums to charity, because the difference between 32% and 40% is 8%. And let's imagine if their average loss ratio was 35%. Now the amount given to charity will be 5%, because the difference between 35 and 40% would be 5%. But let's say if the loss ratio for that cohort of people was on average 42%, say, then Lemonade wouldn't actually give any of the premium to charity because they just haven't made enough. They've actually had too much of a loss ratio for them to give any money to charity. So that is actually a lot less risky than a lot of people think. I mean, that's the way you're supposed to do it. You're supposed to give money to charity if you're able to, not just give money to charity regardless of how good or bad you're doing. So I think that's a very good structure from them. Okay, so moving on to this concept of ceding commissions. This one's quite exciting actually. So as Lemonade's loss ratio drops, it could inspire confidence in its reinsurance partners. This could help Lemonade negotiate more profitable reinsurance contracts in the future. For example, the company currently receives a 25% ceding commission on each policy, but as its loss ratio drops, an indication that the company's underwriting abilities are improving, its reinsurance partners might be willing to bump that up to 30% or more. So basically what ceding commission is let's say Lemonade writes a policy for a customer and they find an external reinsurance company to insure that policy. So what they've actually done is they've given business to that reinsurance company, this external company, and that company is thankful to Lemonade for giving them business. So they actually give Lemonade a commission. So the commission is currently 25%. So that's kind of a win-win already, because if you imagine, Lemonade are reinsuring their product and that lowers their risk, but at the same time, they're actually getting a ceding commission for that. And what's even more exciting is because Lemonade's collecting so much data and lowering the risk so much for the insurance company, they're actually so happy to do business with Lemonade that there's a chance in the future that they might say, because your policies are so good and the risk is so low, we're going to give you, instead of 25% ceding commission, we're going to give you 30% ceding commission. So that's almost a win-win-win for Lemonade. Anyway, some final remarks. So as we all know, you've probably heard a lot, insurance company is one of the largest industries in the world. US insurance premiums totaled $1.3 trillion in 2019, which is a 6% of the GDP. And insurance premiums worldwide total $6.3 trillion in 2019. So it is a massive market that Lemonade have. But one thing I found very interesting is I recently read a book called 0 to 1 by Peter Thiel. And he basically describes how disruptive and innovative companies approach monopolizing an industry. And the way he says you're supposed to do it is actually targeting a niche first. And that's what Lemonade are doing. Let's take Amazon for an example. So Amazon didn't go straight into the online business and say, I want to sell everything to everyone. What they did was they said, let's go into the online business and we're only going to sell books to people. Once that was successful, they moved on to things like CDs, and then now they're literally selling everything to everyone. They are the monopoly of the online retail business. If we compare that to Lemonade, Lemonade are doing a similar thing where they didn't just come in and say, I'm going to sell every type of insurance product to everyone. They started off with renters insurance in the US. Then they upgraded to homeowners insurance as well. And then later on, they added pet insurance. And after that, they expanded to Europe as well. And then now, more recently, they started adding term life insurance. So as you can see, Lemonade are disrupting and innovating in the correct way in order to monopolize. And it really is something that I'm quite excited about. If they are able to monopolize the insurance industry, that is going to be massive. And we're going to see the stock price be a lot higher than where it is now. Anyway, again, you've probably heard this one a lot as well. So over the past 4 years, we've managed to reach 1 million customers when it took the incumbents such as State Farm and Geico 22 and 28 years respectively. That just shows the power of AI and data, and also the brand of Lemonade. Okay, so this is quite an exciting thing. So premium per customer is increasing at quite a significant pace. So the premium per customer in Q3 of 2019 was $169. That increased to $201 in Q3 of 2020, just 1 year later. That's a 20% increase in premium per customer. Now the way that works is, let's say someone is a 19-year-old, for example, and they are renting a flat and they decide to get renter's insurance, for example. When they decide to buy a home, they have to upgrade to homeowner's insurance, which has a lot higher premium. And then they might decide to buy a pet. And then once they buy a pet, they have to get pet insurance, which increases their premium further. And then they might start a family later on, and then that results in them needing term life insurance, for example. So as you can see, the premium per customer actually increases over time. So not only are Lemonade rapidly growing their customer base, but each customer in that customer base are actually growing in terms of their premium. So this is how Lemonade are going to exponentially grow, and that's very exciting. And then finally, just to reiterate the point that they are putting a lot of money into marketing and research and development. They actually put $57.5 million, which is 78% of their revenue, into marketing during just the first 9 months of 2020. So similar to Amazon, like I said, Amazon didn't make any money in the first 20 years because they wanted to grow their business. And Lemonade are doing it in the right way. So I'm very bullish about this company. Let's talk about the stock price. So as you can see, we're at $124, which is relatively stable today, but we've had a massive sell-off of almost about 30%, 31% now. This is not just Lemonade. The whole tech sector has been selling off. And with Lemonade earnings coming up, it could be quite volatile still. But personally, I see this as a very good buying opportunity. So I've already got a position. I'm planning to add more stock to the Lemonade position. If I didn't have a position, I probably would start dollar cost averaging into this stock now, especially with this nice pullback. It's definitely a good time to get into the stock. Personally, for me, that's how I feel. I'd love to hear your thoughts on the stock price though, and on the company. So thank you so much for listening. I'll speak to you in the next one. Thank you so much.